So the purpose of this is to tell you a bit about Phoenix. I was at Artemis for 12 years. I ran the Artemis Alpha Trust, and my trust, the one I ran, which was Artemis Alpha, merged with Aurora at the end of last year. The subject of the talk is price and value. I think it's a very relevant thing to talk about in the UK today. But what I'm going to do is tell you a little bit about Phoenix, the trust, talk about price and value, illustrate it with an example, and then bring that back to how you might relate that to the trust. So I'll start here, which is what the objective is. The objective of the trust is to grow your capital over the long term, outperform indices, and to do it with a lower risk profile. The way we do that is we invest in businesses which we think will earn a high and sustainable return on invested capital. And really, it's kind of in the name of Phoenix. What we tend to do is invest at times when we think there's a big dislocation between price and value. And what is different from us is we use a very filtered approach to look at the universe. So there's only a narrow subset of stocks or companies, as we like to look at it, where we feel we can be confident in asserting our judgment of value, and therefore being quite confident when we invest in price. People who know us, we're based in Barnes. Phoenix has been going since 1998. And we are value investors, and we tend to be known for the depth of our research, and hopefully that might come across to you in the example that I used today. I thought I'd just mention a couple of the points that I think distinguish the approach that Phoenix uses from other investors that you might hear from today. So first and foremost, we are value investors. What does that mean? I think in my mind, that means multiple things to different people. But to us, what that means is that we look at stocks as businesses, and we think why you do that is so you can distinguish between value, which moves slowly, and price, which is frenetic. And that is a function, certainly in the short term, of the emotions and sentiments of people who are making those prices by buying and selling. We believe in deep research, so we think you can only have a solid view on the value of a company, which if you remember one thing to take away from that, is buying an equity you could hold forever. So really, when you're doing the work on a company, you need to be able to make a judgment that doesn't just last 1 or 2 or 3 years, but really should endure 10, 15, maybe even 20 years. We have a focused approach. So some people like to view that as concentration. So our top 5 holdings can account for more than half the portfolio. And again, that relates to what I said earlier, which is well, we think you should only diversify to the point that it protects you against mistakes. And again, that's a very different view from how some people look at it. We do aim for capital preservation. So on each individual investment we make, we have a very concerted effort to make sure that is not loss-making in isolation. And again, if you listen to a biotech trust today, that is very different from the objective that they would have, which is they would very understandably know that some of the investments they make will be loss-making. And then lastly, Phoenix is set up as a learning organization. So over time, we're looking to improve and be humble about making mistakes, because that's a really fundamental element of fund management. Unlike, say, being a heart surgeon, as a fund manager, if you're good, you're probably only getting it right half the time. And if you're really good, you're probably getting it right 60 to 70% of the time. Over the 25 years that Phoenix has been in existence, we've roughly got it right by number of investments 90% of the time. This is the performance of the Phoenix UK fund since its inception in 1998, and it's effectively outperformed the index by 3.5% per annum net of fees. So that's a return of about nearly 9% compared to the index doing about 5.5%. The trust we run is slightly different from other people you will listen to today. So there is no other way to invest with Phoenix as a retail investor other than the trust. And so we have no open-ended alternative, and that is partly a function of the concentration we have. So an OEIC or an open-ended unit fund has limits on concentrations that would make it unsuitable for our investment style. We have the record that I talked about, and then we have a very unique fee structure. So we charge no management fees and only charge a performance fee on outperformance. And even that outperformance needs to be held for at least 3 years. So we can't just have one good year and charge you a fee. It needs to be held for 3 years at least. Otherwise, we give you back the money that we earned as fees. So I think that's a very unique fee structure. And what it means is that I truly believe we're aligned with you as investors. This is Aurora. So Aurora started with 20 million in 2016. It's currently 300 million of net assets. The jump you'd see at the end of the period there is due to the merger of Artemis Alpha. So Artemis Alpha and Aurora merged. That increased the size of the vehicle from 200 to 300 million. And this is the performance. And if you look at the performance, there are a couple of things. Firstly, you'll see it's lumpy. So that's one of the outputs of our approach, is that we will aim. We don't aim to do it, but we don't believe volatility is a fair reflection of risk. And what you'll find is that we'll have years where the fund does nothing, and then it lurches up. And over time, we've actually never had more than a 12-month period where we've lost money. So any drawdown we've had, we've reversed it in 12 months. But because we look nothing like the index, we will deviate very sharply from it in the short term. And clearly our ambition is to materially outperform it in the long term. Now, I'm going to talk about price and value, and I'm going to do it illustrating a stock. One thing I just wanted to make really clear is that one instrument doesn't make a band. So this is not meant to be a reflection of you should buy this stock. It is just meant to give you an insight into how we think and how we invest. And I truly do mean that. In 2022, we had 1% of our portfolio generate 20% of the return in the year. We had an inflation hedge, which was aimed at protecting us against an unexpected rise in interest rates. And if you think about it, if you were just looking at the portfolio, you wouldn't have had that protection that we had. So please bear in mind, when I talk about a stock, I'm trying to tell you about it in the context of our portfolio. And the analogy I like to say is, one carrot doesn't make a carrot cake, or a trumpet doesn't make a band. So please bear that in mind. So price and value. I think this is really key and important and to understand the part of the approach. This is what we're trying to do. This is really fundamental. What we're trying to do is identify businesses that can earn a 15% return on their invested capital over the very long term. The long-term part there is imperative. Why? 15% over 5 years, you double your money. 15% over 10 years, you make 4.5 times your money. 15% over 25 years, you make 33 times your money. So duration is a really important feature. And evidently, most businesses can't earn 15% over 25 years because there's this thing called competition. If you're earning 15% and bank rate's 4%, someone should lend you money to go and invest at 15%. And that's often what happens. And that's why good businesses ultimately are susceptible to competition and disruptive forces over time. So really at the core and essence of our approach, down this residential road in Barnes, what 10 people in the investment team are trying to do is identify these businesses which are great and which will earn a 15% return for as long as we can see. What then happens, you'll see, is price. Price fluctuates a lot in the short term. It can reflect optimism. AI is going to change the future. Therefore, people feel positive about it. Or, oh no, Brexit's happened. The UK's in the doldrums. Rachel Reeves has hit us with more labour costs, and it means that there are more sellers than buyers. So what you find in the short term is you get these huge deviations in price, even though value is this thing that is actually very slow and changes gradually over time. So, and it's kind of back to what Ben Graham used to say about how stock markets are a voting machine in the short term, but they are actually a weighing machine in the long term. And in our minds, what value investing is trying to achieve is firstly to identify what that blue line is, what it's sloping and how long it will persist for. But then secondly, trying to invest intelligently to align yourself to earn a return that's similar to what the business will earn. So you can just imagine if you pay a high price for something, you might not actually earn what the investment's making. So Novo Nordisk might be a fantastic business, but there might be a price at which your investment returns aren't going to correlate to what the underlying business is generating. And similarly, the vice versa can happen when you invest in a really good company that's fallen on tough times. And that's really why the company's called Phoenix. Because what it then looks like is that it's risen from the ashes. What the reality is that you've just invested at a low price for something that you always perceive to be great. So I'm going to apply this to Barratt Redrow, which is one of the UK's largest house builders, a stock that Phoenix has had an investment in for over 20 years. And I'm going to try and explain to you through that lens of price and value for why we think the value and price are very dislocated today. So for those of you that don't know Barratt Redrow, it's the largest house builder in the UK. It's been going for 67 years. It's got a land bank that's valued at over 5 billion, and it has over 94,000 owned and controlled plots. This is just a thought experiment I did to try and illustrate to you how much price and value can deviate. So if you look on the bottom left-hand side, What I've done with the blue line is take Barratt's net assets, which in 2010 were £1.60 a share, and I've compounded it up by 15% a year in a linear way. And what you'd find is you would have had something worth £6 at the end of the period. And what you can see in the price of Barratt is it kind of bared no resemblance to the reality for quite large periods of time. So from 2010 to 2013, it traded at less than the value of its tangible assets. And then from 2015 to 2018, it went from £1 a share to £6 a share. And what you can see is over this 10-year period, actually, that your investment and price returns through this way of looking at it converged over time, but there were really big divergences in between. If we look at what's happened more recently, and I took that £1.60 and kept on compounding it over time, you would theoretically have an investment return of £13.50 a share, but Barratt's trading in the market at £4. Now, some of that difference, and I'm simplifying here, is down to things like dividends. So you have got £3.50 of dividends over time, and about £1 billion has gone into cladding provisions for building safety renovations post Grenfell. But if you see, my simple point here is that our view is that we're in a period of time where there's been this big dislocation between price and value, and actually we think Barratt is worth £12 a share today. Which is illustrated in this chart. So here what you can see is Barratt trades in the market at £4 a share, or 6 billion. And for that 6 billion, that's actually the land it's got on its balance sheet, the land and work in progress. So you're pretty much paying its tangible net assets. And you can see that there's this big gulf. There's almost £11 billion of value that we think exists that's not reflected in the price. So let me explain why we think that exists, and also why we think we're confident about that existing, and why we don't think that's changing. So there are a couple of reasons. Why do you get these big divergences between price and value, and particularly in this case? So the first thing I'd say, and this is a common feature of elements of Phoenix investments, is we think that the barrier to entry, or the moat of the company, what's really generating that blue return over time, is not so obvious. So in the case of house building, it sounds like a cyclical industry. It sounds like it might be easy to do. It sounds like you could go and borrow money and buy land. But the reality is there hasn't been a new national house builder since 1974. And why is that? There are a number of reasons, but one of which is the planning system. It's very hard. Even with changes that you're trying to make today, if you tried to borrow money to buy land, firstly, you'd find that hard to do because people don't lend against land. But secondly, you would have possibly 2 to 3 years of waiting, maybe longer, 6 years as it's been post-COVID, to have that land approved, and you'd only have one site. So imagine the risk of the construction on one site. And we've seen this in play because we've seen how hard it is for house builders to grow. Vistry is an example of that more recently. You can end up in a problematic situation if you try and grow too quickly. But even Barratt back in a decade ago, when it was trying to grow regionally, you could see how hard it was to achieve. So that's really one point, is we think that blue line isn't so obvious. Whereas if you think of a company like Apple or Meta, it is kind of more clear to a 16-year-old why it's got a moat. In the case of house building, it's maybe not so obvious. There's a second point, which I'm going to explain to you visually, which is the accounting of house builders we don't think reflects the reality. So if you were to look at a house builder's accounts, this is what you would see, is effectively what they try and do is they try and buy land, sell the house, and they're looking to make about a 20% profit margin. It looks like this, but the reality is actually more like this, is you buy the land in year 1, you sell the house in year 3. So what happens if prices fell or if costs rose in that period is you effectively are going to have your margins squeezed because the way you account for it is based on what you paid for the land. It's not accounted for in what it costs you to replace the land. And the cash cost of replacing the land is actually what matters to the economic value of the company. And so this I illustrate here is what you can see is what we've had more recently is we've had costs rise unexpectedly. So if you bought land in 2020, it looked like cost inflation was pretty benign. What happened? Cost inflation actually rose 20%. So you can imagine if you bought land to build a house in 2020, when you come to sell that house in 2023, you found that the build costs were much higher than you expected. So what happens is when you actually are buying land to replace that house that you're selling in 2023, you're paying a lower price for the land. But that's not reflected in your profits. And therefore, we think the house building accounts are misleading. They don't tell you that the economic value of the houses. The second point, which I'll explain to you about the value, is to do with the growth possibility. But let me explain this Let me explain to you in a more detailed example why we think the current economics of Barratt are better than they look. So if you look today, Barratt's producing 17,000 homes. It was doing about 23,000 in 2019. If you look at the gross margin, it's reported at 17% today, but we know house builders actually buy land at a 23% gross margin. So if you look at what will happen is when you replace that land at the higher gross margin, your operating margins will rise. And what that means is you go from a company that's earning 400 million today to a company that's earning $1 billion. And that's on a company that's worth 6 billion. So you can see why something may not look cheap when it's valued at 6 billion and it's earning 400 million. But if you think the true economic value being generated is closer to $1 billion, then actually clearly 6 billion looks like it might be an attractive price. There's another factor to consider here, which is particular to house building, which is if you think about it in the last few years, we've had some really big headwinds to house building. So Help to Buy was taken away. It's quite hard to get on the housing ladder. You had interest rates rise unexpectedly, quite materially, from close to 0% to about 5%. Taxes went up. And the planning system got more difficult because of COVID. People worked from home and everything got more difficult to do. And then you've also had building safety regulation. Like I said, Barratt had $1 billion, which has been provided for rectifying homes, which otherwise could have gone into the land market. And what we all know from reading the papers today is that the Labour government is prioritizing builders, not blockers. Even if you looked at the autumn statement last week, you could see one of the key initiatives is improving the planning system because it's something you can do to boost the economy that actually doesn't cost you anything. So if you think other things, if you think housing is one of the easiest ways for a politician to stimulate the economy because it's got such a multiplier effect. If you increase the number of new homes built, it increases the number of washing machines sold, it increases all sorts of things in the economy. And therefore, there's a clear multiplier effect. And here we had a planning system that was blocked and that was leading to a loss of economic output. So you can see today that a lot of these factors are changing. Demand stimulus, maybe not, maybe it will change, but certainly interest rates are coming down, taxes are stable, and the government is putting a real emphasis on improving the planning system. If you look today, last year, we generated about 200,000 homes. Household formation in the UK has been running at about 300,000 homes. So on any sort of metric you look at, there's about an accumulated deficit of about 1 million homes in the UK. That's the underbuild, and that's why you see in the last 2 years, what happens when you can't build the homes is rents rise quite materially. So, and why do rents rise is because housing is a fundamental need. So if you can't buy a house, what do? You rent a house. When you have more renters than you have available supply, rents rise by more than inflation. Rents rose in London by 30% last year. In London, it's one of the most acute shortages of housing in the country. Like I said to you earlier, it's not easy to grow quickly in house building. So if you look at the Labour targets, you effectively need a 50% growth in the volumes of housing output. And it's really hard to see how you can do that quickly. So what I show you in this chart is if you grew at even 5%, you wouldn't have the targets being met till 2032. And apologies that the axis looks like it's been blurred here. But what you'd see is it's really very unlikely that these targets are anywhere near from being met in this government. But it does have quite an important impact on value, right? Because it's all great if you have something making $1 billion, but something's far more valuable if you can reallocate more capital to it and have it grow over time. And so here what I illustrate to you is if you grew at 5% and got up to 250,000 homes in 5 years' time on the same set of economics, and I were to assume that house price inflation was 2% per annum, you'd have Barratt making about £1.2 billion of net profits. And over 10 years, you'd have Barratt making nearly £1.8 billion of profit. And that would be if the government were to be meeting its target in 8 years' time. And really, it's quite a reflexive system in housing, because if you don't meet the target, what's likely to happen is house price inflation is likely to be higher. And also 2% house price inflation is quite, I think, a conservative assumption, given that wage inflation in the UK is rising by more than 2%. And there's a really interesting thing about housing as an asset that I think you should remember, which is it's a very unique asset, because if you're thinking about pricing a house, it depends on the earnings power of who can live in it. And that's why housing as an asset over time has been shown to be a really good inflation hedge. And that's why it's quite an odd situation that we've got house builders at half the value they were in 2019, but we've had a lot of inflation. And really that's what we think is just actually a very big gap between the price of house builders today and their value. I'm gonna just mention a couple of things about the trust and how you could use this type of framework to think about the trust. Because if you were to think about the UK in a wider context, what I think is happening is you have this price and value disconnect being applied across the board. So what looks like poor performance relative to the US might in reality actually just be pent up returns, because what you will have going forward, if you invest in the right companies, is have your investment return actually match the business return because prices are low. So this is Aurora today, and you can see that so investment trusts are a funny thing, because you effectively can buy a trust at less than its value, right? But the funny thing about trusts is it's called a net asset value, but kind of like I just said to you, it should really be called net asset price. It's not the value. So at Phoenix, what we've done, and we've done this since 1998, is we estimate what the value is of every company we hold. And we look at that, and we think we do it in a way that's been fairly consistent over time. And what you'll find is that we think the value of the companies we hold, based on the trust today, on its weightings, are actually 650p. 1 minute. So here's what looks like a 10% discount, we think is actually more like a 65% discount. And so instead of there being 10% upside to the price, we think there's actually more like 170% upside to the value. And I'll illustrate it to you in this way, is if you looked over the last 5 years, the price of the trust is almost flat. But we think the value has been compounding at 9% per year. So this gap between price and value that you see in a stock, which hopefully I've illustrated to you, is what we think is actually also the case in the trust. And that's why, compared to 2019, you might have the same price, but you're getting so much more value. The last thing I'll just say, and this is again only for illustrative purposes, is you could run a scenario and you could say, we discount things at 7.5%. We think a fair upside to intrinsic value is 60%, not 170%. That would be consistent with earning a 10% return, not 7.5% return. So you assume the UK stays cheap. And if that were to happen, it would imply that the trust could compound in the mid-teen range over 5 years and similarly over 10 years.